If you are someone who has ever gone over an article or a video about the stock market, you must have heard about the terms bear and bull market. These terms can be pretty confusing for someone who's not into stocks. In this video, we'll explain the difference between a bear and a bull market and why it's important for you and your money. These two terms are important for investors because they are an indication of what is happening on the market, and knowing when you're in one can help you manage your responses. A bull market is roughly defined as a market where share prices are rising, encouraging investors to buy. During a bull market, market confidence is strong and investors are ready to purchase stocks to build significant gains. A bear market, in contrast, is the complete opposite. Investors want to sell their investments because they're afraid the market may fall. Being an investor in the stock market isn't simple, and bear and bull markets can cause investors to act irrationally and emotionally. It's necessary to understand what bear and bull markets mean and how they may affect your investing plan to gain maximum profits from the market. So let's dive in a little deeper. What is a bull market? A bull market is a longer-term increase in stock prices and a comprehensive market index. The general agreement is defined as a rise of at least 20% in stock prices that follows after a 20% dip, but this can be applied to anything that is traded, such as real estate, commodities, or currencies. During a bull market, there will most likely be little dips, but they will appear as minor deviations, and the overall line will be shown an upward trend. During a bull market, there's a lot of optimism and investor confidence and a lot of desire to purchase stocks. But what are signs of when the market is bullish? Many factors can be looked at, but here are some of the main ones. Higher investor confidence. Everyone loves the opportunity to make money, and when in a bull market, investor confidence tends to be very high. With the sight of stock prices increasing, investors tend to be incentivized to buy more. This further pushes the price of the stock up because of supply and demand. Strong GDP and lower unemployment. We'll typically see bull markets when the economy is growing and strengthening. The gross domestic product, or GDP, of a country is the broad measure of a country's overall domestic production. It's a snapshot of the economic health of a country. In bull markets, countries will see a positive growth or expansion, thus indicating a strong GDP. A strong GDP also tends to correlate with lower unemployment because if a country's domestic production is expanding and growing, then that means more and more of its citizens are at work, typically showing in lower unemployment rates. Growth in corporate earnings. When publicly listed corporations announce their quarterly results, they tell us their bottom line, net income, and sales growth. They also disclose revenue, what occurred in the previous quarter, and what they predict to happen in the next quarters. If those figures are favorable and within or beyond expectations, you may see companies pledge to invest more and more into their business and marketing to attract more investor spending. What is a bear market? A bear market occurs when the market is down 20% or more from its previous highs. During a bear market, the economy may be shrinking. People are being laid off and losing employment, and as a result, they're not spending as much money. Instead, they're saving for worse times ahead. People are more scared, apprehensive, and risk-averse. Here are a couple of factors that could indicate a bear market. Events beyond our control. Events such as natural disasters, pandemics, political conflicts, and pandemics can negatively affect the stock market. These natural events are beyond the control of the stock market and the economy, but they may affect the production of goods or services, thus affecting a country's GDP. Excessive risks. Events unrelated to the stock market might also create a bear market. When there's excessive risk-taking, a risk bubble might form and burst. The housing market bubble that occurred around 2008 is one of the clearest indications of this. The impact was far-reaching, and the market responded negatively, diving into a bear market and eventually into an economic recession. How should you invest? Here's the thing, it's never a good idea to try and time the market. The best time to be investing in the market will always be right now, regardless of whether the market is in a bull or bear phase. You should continue to have a long-term view of your investment plan. Here are a few things you can do to ensure you're not being too emotional about your money as we cycle through bull and bear markets. Diversify your investment portfolio. Diversifying your portfolio means spreading your investments into different companies or sectors rather than a few. Whether in a bull or bear market, your goal should always be to diversify your portfolio. This allows you to weather any downturns and expand your money over time. If you have a substantial portfolio of individual companies in various sectors, you'll be able to weather the storms. Diversification with the intent to buy and hold are the keys to long-term gain in any market, bull or bear. When your portfolio contains companies from every industry, you wouldn't have to worry about which sector would be more affected. Remember that bear markets are unavoidable. As the saying goes, what goes up must come down. Don't chase after results. Constantly shifting your strategy while going after performing stocks can be disastrous. You're going after something that is constantly changing its direction. If you change your strategy constantly, you have a higher chance of missing your target. Rather than looking for the needle, purchase the entire haystack. If you buy the whole stack, the needle will be in there, so you don't have to waste your time, energy, and sanity looking for the needle, which many of us don't have the time or talents to do. Again, investing in index funds or ETFs is a terrific way to access the entire haystack. Set it and forget it. If you're a new investor, start with an index fund and then move towards buying and holding. This has shown over time that it works and leads to a profitable investment portfolio. The key here is patience and time. People may complain about having to wait 20, 30, or maybe even 50 years for their investments to grow and mature, but all of us have to wait for good things. The stock market race is won by those who move slowly and steadily. Be aware of your feelings. Fear and greed are the most prevalent emotions when we invest. When the stock market falls, we may get anxious and be tempted to sell our investments. However, it's essential to be patient. Remember, time is on your side if you're a young investor. If you're an older investor or one closer to retirement and you're feeling anxious, then maybe it's time to look at the diversification of your portfolio. It may be that it does not align with your personal risk tolerance. Remember, it should still be diversified across sectors, regions, sizes, categories, and asset classes. Index funds and ETFs can help with this. It would be best if you did not change your investment plan in a bull or bear market. This is especially important if you're a long-term investor with decades ahead of you. Continue to invest, continue to buy, and have patience. Both bear and bull markets will have a significant impact on your assets. Therefore, it's a good idea to pay attention to these suggestions. Remember that the stock market has given good returns over the long run, but the months and years in between are always fluctuating. So that brings an end to this video. If you learned something new today, like this video and share it with your friends. Please consider subscribing and hit that bell icon to get notified when new videos drop.